First of all, my rules on how I trail swing trades are the exact same as my rules on how I would trail something on a 5-minute chart or a 15-minute chart or an hourly chart or any time frame chart. The rules don't change. It's just the time frame changes. The larger the time frame that you're trailing on, the higher the risk, higher reward. You're willing to give back a lot more in order to potentially make a lot more. But briefly, I have 3 rules for trailing: pivot low, ADMA catch up, new highs. So you need a pivot low to come in, and then the ADMA, the price of the ADMA needs to be at least that price. So if you're trying to argue that the low of this bull flag here is really a pivot, which I can understand that argument, 246.88 then is your last low, but the ADMA right now is at 245.39. So I would only raise my stop to 246.88 when and if the ADMA is able to actually get above that price. And the third rule has already been met, which is that a new high has come in, right? So the only thing that I'd be waiting on if I was trailing Microsoft on a daily chart would be for this ADMA to catch up to the price of the last pivot, which is not really a pivot. It's kind of a bull flag, but as far as I'm concerned, it's the same thing. Now, I do sometimes, I was doing this a lot with INSG when it was an expensive stock. Up here, every time this thing got really, really extended, I would take some off with the idea of I'm going to buy it back when the ADMA on the daily catches up or price catches up, right? So when we get really extended, and really extended is definitely subjective, I would take some off and then I would rebuy it on the ADMA and I would keep the difference in between. Now, in theory, sometimes the opposite could happen. Where what if I got this candle, right? We all see this in big momentum names. What if I got this candle and then I got that candle again? Maybe even I got that candle 3 times in a row. We saw that a lot in November, December, January, when we were seeing a lot of those crazy companies moving 100 to 500% over the course of like 3 weeks in some occasions, right? So what you're risking is that you're taking this off because you think it's extended and then it becomes significantly more extended. So I would never advocate entirely getting out of the position, but into a degree of extension, just to rebuy after a price or time correction. You might even be buying it at the same price. I don't dislike that idea. It can put some money into your pocket. You just got to be a little bit careful with it. I like to do it into extreme extension. So when I have a stock that's really moving in my favor and I'm swinging it on the daily chart or whatever, the only 2 times I would ever really consider getting out of it are because it got extremely extended, or because my trailing stop triggered and I'm actually getting stopped out. So you just gotta be a little bit careful being too cute on taking things off when they have a big move and expecting that you can buy them cheaper, because sometimes you won't be able to. And then sometimes you'll end up missing a much bigger move because you were trying to keep, make a little bit of money for yourself in the meantime. It's not to say I don't do it. I do. But I always try to keep at least a core position that I'm going to continue to swing, unless the degree of extension just becomes absurd. So those are the trailing rules I have.